Are you cold, Manuela? You... My mum lives in Collie. It's like -2. So let's get started anyway. Okay, so you've got the handout. She's got a big turnout today, but you guys will have the advantage because, guess what? Exam. All right, what did we learn last week from Chapter 9? We did an introduction to consolidation, highlighting the fact that deciding whether we need to consolidate or not depends on control. There's 3 primary elements of control: power, variable returns, and also being able to use its power over the investee. Right, last week we also learned that following on from AASB 3, where we looked at business combinations, we need to tax affect everything in the acquisition. Right, sometimes in the acquisition, remember, we need to adjust for fair values. We also need to adjust for goodwill and contingent liabilities. We may also need to adjust for a few other items. Sometimes those adjustments can be done in the books of the subsidiary, and when they're done in the books of the subsidiary, we don't need to do anything with it. But when they're not, and we do it in our on consolidation in the business combination valuation reserve, then we need to make sure that we do that and we carry those adjustments through every year. So if the business combination happened in 2014, it's now 2019, we still have to keep that consolidation process going, right? And consolidation is on a separate worksheet, right? You're not actually changing anything in the books of the parent or the subsidiary, you're doing it on a worksheet, right? So that you eliminate the equity and that you're only showing the assets and liabilities of the subsidiary. All right, so we'll make that clear again as we go through again. All right, is there control? Now in this unit there will definitely be control because they are all 100% subsidiaries, right? So any calculations that you do will be 100% subsidiaries. In later units we might look at others where you only have 60% or 75%. So is there control? Remember, 3 criteria for control: power, your access to variable returns and to be able to influence that, and then also your being able to use your power, right? And that's primarily through voting rights. So in determining if there is control, it only becomes a problem where it's less than 100%. Working out if it's less than 51%, if your ownership is, say, 45%, deciding whether you have control at 45%, right? And then deciding, because obviously if there is control, consolidation is required, all right? But those decisions, from a theory point of view, you might need to know the answer, but from a practical point, remember that we're only doing 100%, all right? The other thing that we have to do there in step 3 is make sure that all the policies are consistent. So for the purpose of this unit, we will highlight that they are consistent, right? We don't have enough time to actually go through and maybe restate all the subsidiaries' accounts to have a similar depreciation, for example, or if they have a slightly different revenue recognition technique, right? But where there are differences, then we need to make sure that all those policies are consistent. Then what's step 4, we need to do our consolidation eliminations and our adjustments. So the other thing to highlight is that from a taxation point of view, where you pay tax as a group, all the tax effect adjustments that we do aren't applicable. But where the individual organisations pay their own tax, then we have to tax affect everything. All right? Okay, so let's have a look. So just a reminder, we reviewed that business combination valuation reserve account. Again, remember that's a suspense account. It's like a clearing account. So where there are differences between the fair value and the carrying amount of assets being acquired, right? So inventory might be worth a bit more, land might be worth a bit more, and the subsidiary hasn't adjusted their own books to show fair value, right? So if the subsidiary did it, they would do it within their asset revaluation reserve account, right? But if they haven't done that, upon consolidation, we need to do it. And remember, there are some things that the companies cannot do. You cannot show internally generated goodwill. You cannot show certain intangible assets. There are certain contingent liabilities. Well, all contingent liabilities are contingent. You don't know how much they're going to be. So they're not actually in the dollar amounts, they're just in notes. But upon a business combination, if you know what they are and you've reasonably predicted, then you can include them as part of the acquisition. All right? So the balance of your business combination valuation reserve, which also includes the tax-affected differences between your carrying amount and your fair value, at the end of the acquisition, it must be nil. All right, and that happens in the pre-acquisition entry. So remember, your steps on consolidation is number 1, do the acquisition analysis. Right, number 2, you've got to do your business combination valuation entries. Number 3, you do your pre-acquisition entry. Right, you need to do the year of acquisition, then you need to do each subsequent year after that. And sometimes you need to make some adjustments. We'll look at that today. All right. So this is the example we looked at last week where we had an acquisition analysis, a simple one, where we had recorded equity of 10,000 and 5,000. So you maybe had a share capital and retained earnings. And then we determined that the land was undervalued, and upon acquisition we're going to increase its value by 5,000, but we have to tax affect it. If the tax rate is 30%, we're only going to include 70% of that in there. Also, there's a brand name, so that brand would be an intangible asset that wouldn't be in the books of subsidiary, but we're including it, and we tax affect that at 30%. So the fair value of your net identifiable assets in that example was $21,300. If you're only paying $22,000, that's what your consideration is, means you've got $700 goodwill. All right, so remember, when you're buying into a business, 9 times out of 10, you're going to have goodwill. If there is a gain on bargain purchase, it is a rare event, right? It will always be scrutinised heavily. It may only arise if a business is going into liquidation and there's a fire sale or something along those lines. So from that acquisition analysis, we need to do our business combination entries. So our land is undervalued, we need to increase it. So we've got to debit our land, right? But 30% of that is 1,500, so we have to account for the tax on that. And we put the rest into our business combination valuation reserve account. We do the same with the brand, and we add in the goodwill. Right, then the third step is we need to do our pre-acquisition entry. The purpose of that pre-acquisition entry is to zero out the equity, right, bring the business combination valuation account to nil and recognise the shares in the subsidiary. Right, so our shares, what we paid $22,000. Our share capital was 10, our retained earnings was 5 that we were taking over. We need to nil them out upon consolidation. The balance of our business combination valuation reserve, we did our little T account. You can see we've got 3,500 there relating to land, 2,000 relating to the brand, 700 for goodwill, all adds up to 7,000. We need to zero that out. We're going to debit it by 7,000. You can see in our pre-acquisition entry it's 7,000. Right, so from a simple point of view, right, so now we're just going to take it up to the next level and look at adding a few other things to that, and then looking at our entries in subsequent years. So when we've got pieces of equipment that have got depreciation attached to it, for example, we need to account for that and tax affect it. If inventory has been revalued and subsequently sold, we need to account for that. So that will change our business combination valuation entry and our pre-acquisition entry. We will add another level to that. If there's a contingent liability, if that contingent liability gets settled in the future, we need to account for that. So we'll look at examples of that now. All right, so chapters 10 and 11. We've got a lot to get through today. So it's now 3:10. So we've got until 4:30. We'll get done as much as we can. All right, so the first part of it, chapter 10, is the most important. There is definitely a question on that in the exam. So I've already told everybody that in the tutorials and that. definitely a question on this first part. The second part, all right, not as many marks allocated to that in the final exam, but you do need to understand the intra-group transactions. So if we don't get through that, what we'll do in the review week next week is a review. It's up to you what you want me to do. So all I can do is highlight the study pack, highlight the main things, what you have to do, give you a few extra tips here and there, but I've given plenty of tips all the way through. But if there's something specific you want me to cover, we can do that. All right, so if there's anything that you want to make a special request on, you can email me. As long as you email me at least the day before. So, but because ours is on a Monday, if you let me know on the Friday that if there's something specific, like there's a question and there's parts of a question that you didn't quite understand and you want me to look at it a bit more, because next week's tutorial, full, right? Because we've got a couple of questions from chapter 10, a couple of questions from chapter 11, all right? So we need to make sure that, and that's the last tutorial, all right? That's the last chance that we've got. So if we want to do something extra, we can do it in the lecture. All right, so starting off with the main stuff from chapter 10, what we'll do is, again, we're going to do more acquisition analysis using the equity approach, so we're going to extend upon what we already know. We're going to do the worksheet entries. So just so you know, in your handout on page 3, I will not get you to do that in the exam. All right, that is for illustrative purposes, so it's very clear. This is your chart of accounts. These are all your assets, liabilities and equity. This is the parent, this is our subsidiary. Then you add the two together and then you've got your debits and credits and your adjustments and editing for your business combination valuation entries, and then later on any intragroup transactions, which we'll do right at the end. But I won't get you to do that. But from a visual point of view, sometimes if you can visualise that and prepare a mini one in the exam, that can actually help me make sure that you get your debits and credits right. All right, with your assets and liabilities and whether they're increasing or decreasing. All right, so we don't really have enough time to do like a full worksheet in the final exam because we've got a few learning outcomes, right? So obviously the emphasis is on the cash flow. It's worth 25 marks. But this stuff we're doing today, you need to pay attention to. All right, particularly with the worksheet entries, so being able to do an acquisition analysis, be able to do the worksheet entries for the current year and maybe later years. So year 1, maybe year 2, maybe year 3. All right, so your acquisition analysis, your business combination valuation worksheet entries and your pre-acquisition entry for the current year and future years if circumstances change. All right. So, and potentially maybe an intragroup transaction where there's inventory sold between parties, or if property, plant and equipment, or if there is an internal service or something like that. All right. So remember, back to your terminology, your consideration paid is what you paid. So your to work out your goodwill or bargain purchase is what you paid, minus the net fair value of your identifiable assets and liabilities of the subsidiary. All right, so we work out. So hopefully you're comfortable with that. Pretty straightforward. You've done plenty of that with your AASB 3, accounting for business combinations. Now we take it to the next level because we do it upon, we do a full consolidation. All right, so here's an example, just a basic example, just to jog your memory. You have your chart of accounts in the first column, which lists your equity and liabilities. Then it lists your assets. All right, it shows the amounts for the parent and then the subsidiary. Remember, upon acquisition, if the fair value is different to the carrying amount, so the carrying amount is the amount that it is in the books of the subsidiary. If the fair value is a little bit different, so for example, you look at your provision there for your liability, the fair value is the same, your payables is the same, your tax liabilities is the same. However, your land and your equipment is different, as is your inventory. All right, so we need to do some adjustments upon consolidation to highlight the fact that there is a 20,000 difference in your land, your equipment, right? There is also accumulated depreciation we have to account for. All right, and then we need to tax affect those differences. All right, some additional information with that. You've got it in the handout in front of you. All right. At the acquisition date, the subsidiary limited has an unrecorded patent with a fair value of $20,000. So we have to add that into the acquisition. There's also a contingent liability with a fair value of $15,000. Remember, when there's a contingent liability, it's a reduction, it's a minus. All right, tax rate, we're going to use a standard rate there of 30%. We need to do the acquisition analysis, assuming a consideration transferred of $500,000. All right, so let's do our acquisition analysis. If you turn over the page, you've got that in front of you there anyway, and there's some space under there for you to write some notes and for you to write in any little extra notes on journal entries and stuff like that if you want to, although it's already here for you. All right, so your net fair value of your identifiable assets and liabilities, your first line is always your recorded equity. So if you have a look at your balance sheet, you can see that you've got a recorded equity of the subsidiary of $300,000. So ignore the parent column. All right. So if you need to, put a ruler over that so you don't have to look at it, so you don't get confused with the columns. We are dealing only with the subsidiary column. So we've got share capital there of 300, 140 there in retained earnings. We also have to account for the land, and we have to account for the tax effect on that. So land, if you go down the line a little bit in your books of subsidiary, it's currently in there at 150, but the fair value there is 170. So we have to add in 20,000. Right, so that 170 minus the 150 is 20,000, but we need to tax affect it. So we need to minus off 30% or just include 70% of that for 20,000. Your equipment, all right, equipment, we need to look at the carrying amount is 480,000 minus the 170, which gives you 310. All right, so 480 minus the 170 gives you 310. The difference between 310, which is the carrying amount, and the fair value of 330 is 20,000. All right, because we need to account for the accumulated depreciation. Because remember, the carrying amount of equipment and other non-current assets, you've got the value, the historical cost, what you paid, minus the accumulated depreciation to give you the carrying amount. All right, so 480 minus the 170 gives you 310. So the carrying amount is 310. Your fair value is 330, meaning that you need to increase that value by 20,000. Remember, where you've got a non-current asset which is going to be depreciated into the future, we need to account for that depreciation on that 20,000. All right, so the we'll need to do that into the future. So in this example, we'll do that for later years. All right, we've also got inventory. So look at the inventory. It's currently in the books of the subsidiary at 75. Fair value was 80, so we need to increase that by 5,000, tax affected. All right, so we're only going to include 70%. Next thing we need to do is, from the additional information, add in the patent and the contingent liability, tax affected. Add in the patent, because the patent is an asset. All right, and we need to minus out the contingent liability. Add them all up, gives you 475. Now, we were told earlier we're going to pay 500,000 for it. 500,000 minus 475 gives us goodwill of 25,000. Okay, so what we need to do now is, from this acquisition analysis, we can easily prepare our business combination valuation entries. So we're going to have to do it for land, equipment, inventory, patent, contingent liability and goodwill. All right. So, as I said before, where the business combination valuation entries are done in the asset revaluation reserve of the subsidiary, so that means if the subsidiary has recorded the fair value of its assets and adjusted its own assets in its own books, the carrying amount should equal the fair value, shouldn't it? So you won't have to do any adjustments. All right, they haven't done it in this example, so we are doing it upon consolidation in the business combination valuation reserve account, and this is an annual adjustment which is required. All right, So if we did a little T account with all the business combination valuation reserve account items for land, equipment, inventory, patent and goodwill, add them all up, adds up to 70,500, minus out the contingent liability, means we've got 60,000 as a balancing item that we need to include in our pre-acquisition entry. But before we get to that, let us do our business combination valuation entries one by one. We've got our land. We need to increase the value of our land, debit land. We need to credit the tax, 30% of that is 6,000. Credit your business combination valuation reserve by the difference of 14. All right, because the land is undervalued. We've got equipment. So equipment, the carrying amount is currently 310,000. We need it to be 330. There is a 20,000 variation. Right, there's a two-step process in this, and I prefer to do it this way, where you write back the depreciation. So remember, depreciation is a contra asset account. It's currently in your books as a credit. To get it out, we need to debit it. So we will debit the accumulated depreciation, credit the equipment by the 170. Then we need to increase the value of the equipment by 20,000. So we'll debit it by 20, tax affect that. So 30% of that is 6,000. And credit our business combination valuation reserve 14. So we've done a two-step process. I prefer to do it that way because that's how you write it back. So you know that when you've written it back, it was in there at 480. Take out 170 gives you 310. We need it to be 330. Therefore, the next entry we need to increase it by the 20. You could always do a single journal entry which has the same effect, where you debit accumulated depreciation 170 to bring it back to zero. We credit the equipment by 150. All right, because the net effect of that is exactly the same as those other two entries. So you're combining the 170 and the 20. Tax effect the 20 of 30% on your 20,000, and the difference there 14,000. So that has the same effect. All right, so if you want to do it that way, that's perfectly fine. But in an exam situation, when you're doing things step by step by step, sometimes it's better to do the two, because you know you've written it back. This is the value after you've written it back. You need it to be a little bit more. This is the journal entry. All right, so it depends on how you cope with your study and what you're doing. All right, obviously it's quicker to do one, a little bit less writing, not much. You're talking about 10 seconds. All right, in the context of a whole exam, it's not really that much. So we've done the land and we've done the equipment. Now we do the inventory. The inventory difference between the carrying amount and the fair value was 5,000. Right, 30% of that is 1,500. The difference goes to your business combination valuation reserve, 3,500. We need to add in the patent and the contingent liability. The patent is an asset, so we need to increase that. All right, we increase it by 20,000. We've got our business combination valuation reserve is 70% of that, and our deferred tax liability there of 6,000. Our contingent liability is 15,000, so we need to create a provision for a legal claim. It's a liability, so we credit that by 15,000. 30% of that is 4,500, which is a deferred tax asset, and our business combination valuation reserve is the difference of 10,500. So remember, with a contingent liability, it's an expense, isn't it? Expenses, when they eventually go into the P&L, will reduce your profit and you pay less tax, right? That's why it's a deferred tax asset. Where you're dealing with a patent, that potential patent could be, that is a revenue item and a gain, right? Revenue items increase your profit and you pay more tax, so it's a deferred tax liability. Right, so when you're thinking about those and deciding whether it's a deferred tax asset or deferred tax liability, are you going to pay more or less tax? So where you pay less, it's an asset. Where you pay more, it's a liability. All right. So on consolidation, we've already worked out our goodwill on acquisition, back a few slides, of 25,000, and we need to do a journal entry. So we need debit goodwill 25, credit our business combination valuation reserve of 25. So goodwill, there is no tax effect on goodwill. It is treated in this unit as a permanent difference. Technically, it's an excluded temporary difference, right? Because goodwill gets assessed every year for impairment, but it gets treated as a permanent difference. All right, so now we need to go ahead and do our pre-acquisition entry. So we've done our acquisition, We've done our business combination valuation entries, now we do our pre-acquisition entry. The purpose of that pre-acquisition entry is to remove the equity items and just show the assets and liabilities. So if you have a look over the page, on your page 3, where I've got all the business combination valuation entries at the bottom of that table, you'll notice that they are all 0. When you go up to the equity items for the group, the equity items only show the parent. All right, so if you look at the very last column, which says group, they will match, the equity items match the parent. Right, and then we have, later on, we've got shares in the subsidiary. All right. Right, that have been adjusted, you'll see that they are nil. Okay, so we need to avoid double counting, all right? So our pre-acquisition entry, we need to include the share capital and the retained earnings of 301.40. Our business combination valuation reserve balance is 60,000, as I showed you earlier. What did you pay? You've got your credit to your shares in the subsidiary there of 500,000. Right, so what that means is only the assets and liabilities include variations. All right, so we exclude the equity and we are excluding the shares, and all our business combination entries, which I've labelled separately for illustrative purposes down the bottom, they're all 0 as well, because the clearing account, it should be nil. You can clearly see next to it in that column just before the group, I've labelled them with numbers 1 through to 7. You can see the ones that are 7 all linked together, the ones that are 5 all linked together with the debits and credits. You can see the journal entries, what's being debited and what's being credited in the business combination valuation entries and the pre-acquisition entry. Okay. So it's not so hard when you're doing 100%, it's easy. When you're doing 60%, you're doing 40%, when you've got, this is what we had to do. We did this in our undergrad. We had the big worksheet, we had to do the whole worksheet. We had one company that might have been 100%, another one that might have been 70, and another one was 60. We had to consolidate multiple companies all at once and eliminate intergroup transactions all on the same thing and do the worksheet and that accordingly. So it was pretty complicated. But once you got a handle on one, once you've got a handle on this, it's fine. All right, then you just elevate it again. You add in the intergroup transactions, which we'll do at the end. One more elevation, you got another company, which is maybe only 60%, all right, or 75%. And it's just, as long as you're very methodical about it, it's pretty straightforward, all right. So you've got those summary worksheet entries there for you to follow through to see where all the debits and credits, what we've done and what the end result is. All right, and technically you can prepare your balance sheet from all those group accounts there, all right, from that one. Okay, so just double check on your handout though. I've got a feeling that one of my adding up for the land there was wrong. It should be 120 plus 170, which is 270. So I've got 170 there. Change that to a 2 on your handout. I knew I'd done it, but I didn't reprint it because I didn't want to waste paper. So just change that to match up here. So you've got your land under your assets for the parent is 120 plus the fair value of 150. Is that right? To give you the, yeah, that's right. To give you the parent plus a subsidiary, and we need to make it 290, so we've got to add 20,000 to that. All right. So fix that one. Now, what if, same scenario, what if we don't pay 500? What if we only pay 460? So if we're only going to pay 460, we've got a gain on, if you go back to your handout in front of you, the fair value of your assets and liabilities, all right, adds up to 475. All right, your fair value under your acquisition analysis, that's the same as 475, but we're only going to pay 460. So what we have, the difference between 475 and 460, we actually have a 15,000 variation. Right, so with a gain on bargain purchase, when you do your pre-acquisition entry, it goes straight to your P&L. All right, so you have the same entry with your business combination valuation reserve entries. All the same, except there's no goodwill, is there? Right, so it goes straight into your pre-acquisition entry and the parent gets the benefit of that gain on bargain purchase of 15,000. Okay, notice how your shares in subsidiary are a little bit less because you're only paying 460, right, not 500. The pre-acquisition in the next year, you'll notice that your retained earnings has gone down. So see, your retained earnings is 140, right? Because that gain on bargain purchase goes straight to the P&L, in the next year your pre-acquisition entry will be different. Right, it'll be a bit less at 125. Your business combination valuation reserve account is also a bit less. All right, because you have no goodwill, your pre-acquisition entry variance there was a 35, that you can see there. Right, your balancing amount in the little T account changes to 45,500. All right, so it's a little bit less. Now, let's do, what if in the following year, now the land was sold for 200,000? All right, it's currently in our books at, in the subsidiaries books at 150, right? The fair value there is 170 on consolidation, so we've still got that 20,000 variation. But if we sell it for 200, the journal entry, our cash is going to go up 200. Our gain on sale, right, is going to be showing 50, right, in the books of the subsidiary because it's only in their books still at 150, right? And we're going to do a credit to our land there of 150. However, from a group point of view, the gain on sale was actually only 30,000 because the fair value was considered to be 170 and we've already accounted for that extra. So there is an adjustment there that we need to do of 20,000 upon consolidation. So until the land is sold, our business combination entry is going to be land at 20,000, credit your deferred tax liability at 6 and your business combination at 14. However, when the land is sold in June 2018, we're going to recognise and account for that 20,000 and show that gain on the carrying amount on the land sold, 20,000. We're going to credit the income tax expense now, and we're going to use a clearing account to transfer from our business combination valuation reserve. All right, that affects the pre-acquisition entry. The other side to that, the debit to that, all right, is in a new entry in our pre-acquisition. We'll show you that in another couple of slides. All right, so we need to account for that. So that gain on sale, remember, that will also in future years will change your retained earnings. Right. So before we get to that pre-acquisition, because we're still looking at our business combination valuation entries, so we have to account for the depreciation adjustment. All right, so in the books of the subsidiary, it's currently in there at 310,000. If there's a remaining useful life of 10 years, the annual depreciation there is 31,000. However, from the group's point of view, it's sitting there at 20,000 more at 330. So if they have a useful life of 10 years, we have to account for the depreciation of that an extra 20,000 over the next 10 years. 20,000 divided by 10 is 2,000 per year, and we tax affect it. All right. So let's have a look at that. So our business combination entry, we write back our depreciation of 170. We debit our equipment of 20, our tax component of 6,000, and our business combination of 14,000. Now, this is 1 year after. We've got to add in the depreciation debit depreciation, credit accumulated depreciation of 2,000, all right, which is 20,000 divided by 10. The tax effect of that, all right, is essentially what we're doing is writing back that 6,000 over 10 years. So 6,000 divided by 10 is 600. It is also 200 times by 30%. All right, so we have to debit our deferred tax liability. Notice how it's currently in there as a credit. We're going to write that back over the next 10 years. So we debit that by 600, credit income tax by 600. Right, now in the year after, all right, we're going to have to do another adjustment. But we're going to have to do an adjustment for 2 years. We're going to have the current year and the previous year. So our accumulated depreciation, we're still going to write it back. We're going to repeat that. We're going to repeat our business combination valuation entry, debit the equipment, credit the tax, credit our business combination valuation reserve. Now we need to recognise the depreciation. We have got 1 year's depreciation under depreciation expense of 2,000. We've got last year, so the previous year in retained earnings, because remember, when you do depreciation, when you're preparing your accounts, you've got your revenue minus your expenses, gives you a profit or loss that gets transferred through to your retained earnings. All right, there's also the tax component as well, which comes off that. All right, so our journal entry is starts to get bigger. So the next year you would have 2,000 for the current year, 4,000 in retained earnings, and 6,000 in accumulated depreciation. The year after that, it's 4 years. 4 times 2 is 8,000. 8,000 accumulated depreciation, 2,000 in the current year, 6,000 in your retained earnings, right? All prior years go to retained earnings. And remember, this is happening in the worksheet each year when you're doing it. All right. And the tax component for that, all right, so your tax component for the current year is the income tax expense, which is your 600. Your retained earnings, which is your prior year. So we've only got the current year and the prior year. And our deferred tax liability has come down by the 2 years of 1,200. So if it was 3 years, your deferred tax liability would be 1,800. Your income tax expense would be 600 and your retained earnings would be 1,200. Okay. So, another one, business combination, a subsequent one. On the 1st of January 2019, the legal claim was settled for $2,000. All right, it was in our books at $15,000. So, all right, we've over-provided for that, so we need to make sure that we account for it. So in the books of the subsidiary, with the payment of the legal claim, we're going to have a debit to the legal fees expense of $2,000 and a credit to our cash. From a group's perspective, as the liability no longer exists, we need to we don't need to carry it forward anymore. We need to recognise that settlement as a gain or a loss on settlement. All right, so what we have is we've got extra money there in that provision, so we have a gain on settlement. All right, so up until settlement date, our previous entry that we had before stands at debit your business combination valuation reserve 10,500, debit the deferred tax asset 4,500, credit the provision for legal claim. In the year the liability is settled, all right, we need to credit the expense for the legal fees, 2,000. We need to credit the gain on settlement of 13, so that knocks out your 15,000. We need to debit the income tax expense of 4,500, and we need to debit a clearing account, the transfer from your business combination valuation reserve. This affects the pre-acquisition entry, so we'll see that when we get to that slide. So there's 2 items we have done. We've sold the land and we have settled the contingent liability, so our pre-acquisition entry is going to change. All right. So with our acquisition analysis, remember we need to exclude goodwill, so we'll do an example of that later. This one here, if the goodwill is deemed to be impaired, so here in this example, in June 2017, the goodwill is reassessed to have a recoverable value of 18,000. Currently in the books at 25, we need to recognise that impairment, right? So we need to debit our impairment expense and credit a goodwill impairment loss, 7,000. Right? There is no tax effect on that goodwill. Right, in the future years, the following entry is required. We need to do that adjustment to our impairment expense, right, to our retained earnings. Because in the books of them, remember this is just upon consolidation. All right, that expense is affecting that impairment is affecting your profit. Now, with an acquisition analysis, if there are dividends payable, and remember this is 100% owned, right? So if the subsidiary is paying dividends, those dividends are going to the parent. That is an intragroup transaction. So we need to exclude those dividends, right? If it is bought on a cumulative dividend basis, we need to exclude those dividends. So we'll have a look at that in another example later. Right, the pre-acquisition is required every time a consolidation is completed, so it keeps going. They are annual entries. All right, our subsequent pre-acquisition entry. So in the year the land is sold, and also the next one is where the legal fee is settled. So, but firstly, in 2018, when the land is sold, that clearing account, that transfer from business combination valuation reserve, that's the other side to it. That's your 14,000. It's taking it out of that business combination valuation reserve account. All right, so it's no longer in there. Now our legal fee settlement as well, we need to adjust for that as well. So in 2019, you'll notice also that our retained earnings has changed. So it was 140. We have had to adjust for the sale, the transfer from the business combination valuation reserve. That land has gone up to 154. Now we're going to settle our liability as well. Right, so that's the other side to our liability from our earlier journal. Right, then in 2020, again, that will affect your retained earnings. Okay, so there's quite a few different disclosures and that. So AASB 12 looks at disclosures from interest in other entities. So there's quite a bit of additional disclosure that may be required. You need to highlight your policies and procedures on business combinations, etc. Obviously in this unit, I don't expect you to memorise everything in all the accounting standards. The main one, however, AASB 101. You do need to remember what's required in AASB 101 with the preparation of your key general purpose financial reports, your balance sheet, your profit and loss, all right, and your statement of cash flows, etc. All right, so you don't have to go into a lot of detail, but AASB 10 is your primary standard that you use for consolidation. Right, that's the standard that you look at to determine if there is control, specifically in the schedules. So in the schedules at the back of the standard goes into quite a lot of detail about how you determine if there is control or not, looking at power, your voting, your access to variable returns, etc. And there's a lot of things that you need to consider in that process and can be problematic. AASB 3 is used for your business combinations. All right, so looking at your acquisition analysis. So the best way to learn is to do some examples. So in your handout there, so you can follow it through. On your page 4 and onwards, we'll have a look at some specific examples, all right, of what we need to do. So a couple of simple ones. So on the 1st of January 2017, Graham acquired all the issued shares on a cumulative dividend basis. What that means is if there's any dividends, we need to adjust that and remove it out of our acquisition analysis, right? Because the standard tells us that that's what we must do, right? They paid $263,000. That's your consideration transferred. At that date, the equity of Leslie was recorded, share capital of 150, reserves of 40, retained earnings of 60. On the 1st of January, the records of Leslie also showed that the company had recorded the asset of goodwill at 5,000. All right, so upon a business acquisition, we need to remove that. All right, so on your handout there, big circle around that 5,000 because we're going to have to take that out. Further, Leslie had a dividend payable of 10,000, so we need to make sure that we account for that. The dividend was to be paid in March 2017. All other assets and liabilities were equal to their fair values. All right, so what that means is we don't have to do a whole bunch of tax affected journals for our differences between carrying amount and fair value. All we have to do is account for that goodwill and that dividend payable. So we need to still do our step one, do the acquisition analysis to determine if we've got goodwill or a gain on bargain purchase, right? Number two, do our business combination valuation entries. Number three, our pre-acquisition entry. All right, so first thing is our acquisition analysis. So determining the net fair value of our assets and liabilities. First line is your equity. So you've got 150,000 of share capital, we've got 40,000 of reserves and 60,000 of retained earnings. So we need to minus out the goodwill that's in there. All right, that gives us 245,000. Our consideration transferred, what we're going to pay is 263. However, the standard requires if they have a cumulative dividend payable, we need to minus that out of the consideration transferred. We're not going to pay that. We're going to pay 10,000 less, 253,000. So the goodwill, so what our consideration is, 253 minus the fair value of your identifiable assets of 245 gives us $8,000. Right? The amount of non-recorded goodwill, all right, is 8,000 minus that 5,000 already in goodwill gives us a variance there of 3,000. So we've only got one entry that we need to do. We need to do a debit for our goodwill of 3,000 and a credit to our business combination valuation reserve of 3,000. All right, because currently the goodwill acquired is 8. It's sitting in the books at 5 in the books of the subsidiary. Yep.
We've already deducted the goodwill from the net identifiable, fair value net identifiable assets.
Yeah.
Do we have to reduce it again?
Yeah, we take it out at the end because we have to show the difference. So that by taking it out gives us a figure of 3,000. That shows us what our journal should be. Because if you think about in the books of the subsidiary, it's in the books at 5,000, isn't it?
Yeah, but then
So we need it to be 8,000. So therefore, that's showing us our non-recorded goodwill. So we have to do a journal entry for the 3,000. All right, so our goodwill is still the 8, but our journal entry is actually only going to be 3 because if you think about your worksheet, so if you go back, flip back to page 3 on the other example, in the books of the subsidiary, we've got an asset, goodwill, 5,000 sitting in the subsidiary. We don't need it to be 5, we need that to be 8. All right. Okay, so that's all we're doing. So upon the acquisition analysis, that's just the way we do it. All right, so we have to take it out. Well, we take it out, technically we take it out once and then we just minus it out at the bottom to see what our journal should be. All right. Then the next thing we need to do is our pre-acquisition entry. So we've got retained earnings, share capital, general reserve. We're going to eliminate them. So they're all equity items. So to take them out, we're going to debit them. Our business combination valuation reserve, we're going to debit that by 3,000. Our shares in Leslie, 253. And then we've got our adjustment there to our dividend payable. We're going to debit our dividend payable, 10,000, credit our dividend receivable of 10,000 to eliminate that because you can't transact with yourself. All right, that is an intra-group transaction elimination. But in this case, we're doing it upon acquisition because it's done on a cumulative dividend basis. Right, any future dividends, all right, they would continue to keep coming out. Right, so if there's future dividends, if there's another 10,000 next year, we're going to have to do another journal entry to get that out. Right, because in the books of the parent and the subsidiary, they would be showing new amounts in there for payable and receivable. Okay, so let's have a look at the next example. So over the page, we've got an additional example. So on the 1st of July 2014, Flint Limited acquired all the shares in Jasper for 400,000, again on a cumulative dividend basis. Right, upon acquisition date, the equity of Flint consisted of 200,000 for share capital, 100,000 for retained earnings. The fair value of land was 110,000, but the carrying amount was 100,000. So you might want to pop in there that there's a 10,000 variation that we have to account for. The fair value of the equipment was 330. Its original cost was 340 and had a carrying amount of 310. Right, the difference there is the carrying amount is 310 and we want the fair value to be 330, so there's a $20,000 variance that we have to account for. Flint had recorded goodwill of 5,000 and dividends payable of 12,000 at the date of acquisition. So again, we're going to have to take that goodwill out. We're going to have to remove the dividends payable from what they are paying the consideration transferred as well. Okay, so up to there, we're good. But then, on the 1st of January 2015, the land was sold and the equipment, we need to recognise that it has a useful life of 5 years. All right, and we may need to account for that payment of that dividend. All right, so let's do our acquisition analysis. So number 1, line 1, the fair value of our identifiable net assets and liabilities. We've got 200,000 plus 100 as your equity. The variance between your carrying amount and fair value of our land is 10,000. We have to tax affect that. So we only include 70% of it. We need to minus out 30% of that. So 30% of your 10,000 is 3,000. 20,000 on the equipment, we have to tax affect that. So we've got to take out 30%. Then we've also got goodwill that we have to take out, giving us a fair value of our net assets and liabilities. We've got 316,000. Our consideration transferred, so what we were going to pay was 400, minus out the dividend receivable of 12,000 gives us 388. 388 minus the 316 that we just calculated as the fair value of our assets gives us 72,000. Right, for goodwill, but our goodwill adjustment, because there's already 5,000 in there, is 67,000. Okay, so you've got that in your handouts. So let's do our business combination valuation entries. We've got land, increase it, so we've got to debit it. We've got to recognise 30% of that as a tax. The remainder goes to your business combination valuation reserve. Our accumulated depreciation on our equipment, right? If we go back to the original question, it said the cost was 340. The carrying amount is 310, therefore the accumulated depreciation must be 30,000, right? We are going to adjust our equipment by 10, so we've done it in one journal entry rather than write it back and then adjust the 20. The deferred tax liability on the 20, which is the 30 minus the 10 there, is 6,000. That's your tax component, and your business combination valuation reserve account, we're going to pop 14,000 in there. Whoops. Your goodwill, so we're going to recognise debit goodwill 67, credit our business combination valuation reserve 67. Our pre-acquisition entry, we need to zero out our share capital and our retained earnings, 200 and 100 respectively. Our business combination valuation reserve account has got 88 in there. So if you have a look at the previous journal entries, you add up the 7, the 14 and the 67, adds up to 88. All right, the shares in Flint, 388. All right, our business combination valuation entries as at the 30th of June 2015. Now we've sold the land. All right, so with that, in our previous entry, our land account was being debited for 10,000. You'll see in the next entry, gain on sale of land, 10,000. We have got 3,000 for your income tax, 7,000 for your transfer from your business combination valuation reserve. All right, so that is another little clearing account for that 7,000. Then you've got your goodwill of 67. I probably should have separated them out into two journals. So you've got goodwill of 67, business combination valuation 67, your depreciation on your equipment. So we've got to write back our depreciation and adjust our equipment, account for the tax. But our depreciation expense, so we've got 20,000, right? So 20,000 is the difference with our equipment, so the 310 minus 330,000 gives us a 20k difference. The remaining useful life is 5 years. 20 divided by 5 is 4,000 depreciation per annum. Right, debit depreciation expense, credit accumulated depreciation. Tax affected, so do the adjustment for that. Deferred tax liability, 1,200, which is 30% of the 4,000, and credit your income tax expense, 1,200. Your pre-acquisition entry, again, we're going to adjust for our share capital, write them back to zero. Debit share capital, debit retained earnings. Business combination valuation reserve at the moment is 88,000. Shares in Flint is 38,000. Our corresponding entry for the sale of our land there of the 7,000. So if we go back here, notice up here we've got our transfer from business combination valuation reserve for our land of 7,000. That affects our, other side of that affects our pre-acquisition entry. All right, so in the next year, that will adjust. Okay, so we've done our acquisition analysis, we've done our business combination valuation reserve entries, we've eliminated the investments through our pre-acquisition entry. Now we need to go further as we continue on in business with that subsidiary. Any intragroup transactions we need to account for. So that's the next part. So what we don't do in this with consolidations is we don't do the non-controlling interest. So the NCI, that last step, we don't address it in this unit because we only look at 100%. So we address that in another unit that I teach. All right, so just so you know, so that's taken about an hour. So I don't know how far we'll get, but we'll just keep going until we get to 4:30 or just before. All right, so remember that you've got 10.7 is already on Blackboard. All right, you still need to do 10.6 and it is important. So next bit is we've got companies, we've got a parent, we've got a subsidiary, they start to interact with one another. Then maybe they're going to sell inventory, maybe they're going to provide services to one another. There could be multiple different transactions. So essentially you cannot make money from transacting with yourself. All right, you need to eliminate and tax affect any of the components where there are intragroup transactions. So we need to, basically that last line there, consolidation adjustments that will effectively eliminate any unrealised profits because you don't make money by transacting with yourself. All right, so some common examples, transfer of assets, dividends, sale and purchase of stock, fees and interest. So intercompany loans is not uncommon for a bigger parent in a multinational corporation. It's not unusual for them to provide loans to subsidiaries, right, because it may be cheaper than for those companies to go and get loans from banks or other financial institutions. Any receivables or payables. The other thing that's quite common, and this is during the financial crisis, the Asian financial crisis in the late 1980s, 1990s, what Malaysia did is, because they had a major financial crisis, they wanted to prevent multinational corporations from taking any money out of the country. So they banned all monies being taken out of the country. The only way that some companies could get money out, for example, was to send their staff in to be paid. So they got paid a salary, but that salary was exorbitant, and it was just a tool that they used to actually take the money out of the country. All right, so, but the government, they're not silly, they cotton on to these things. So, but that was a loophole. All right, and that was one way that companies were able to actually get money out. So, but remember, if you send management personnel in there, they may need to be paid. All right, so it is a legitimate expense, but when you're preparing your consolidated accounts, you need to make sure that that gets eliminated. All right. So it's not an expense that you can use for reducing tax, for example, because it's still an internal transaction. So let's look at some examples of inventory. So we're going to sell some inventory. The broad effect of an intergroup sale and purchase of inventory is looking at this. So we've got a subsidiary. They sell some inventory for $150 on the 25th of June to a parent. Okay, the external supplier had sold the inventory to the subsidiary for $100 on the 1st of June. All right, so in the books of the subsidiary, they're going to be showing a sale of 150 and a cost of goods sold of 100. So they're going to be showing a profit, aren't they, in their books? But they haven't made a profit because they've sold it to a parent. They haven't sold it to an external. So upon consolidation, we need to make sure that your group accounts only show transactions with external parties. All right? So we need to eliminate that sale. So if all the inventory is still held by the parent as at the 30th of June 2016, we need to make sure we eliminate that sale. To eliminate that sale, we're going to, because remember in the books of the subsidiary, they would have a credit to their sale and a debit to their cost of goods sold. All right? So they would also, so the two journal entries would be debit bank for 150, credit sales 150. Right? They would also have a debit to your cost of goods sold and a credit to your inventory for 100. Right, so that's currently in the books of the subsidiary. We need to remove that. So to remove it, we're going to debit your sales 150, credit our cost of goods sold by 100, and credit our inventory by 50. All right, to highlight the fact that the only thing that should be in there is the original value of the inventory, because that's the only transaction with an external supplier. So your group account should be showing $100 for your inventory. All right, so there's also the tax component, because in the books of the subsidiary at the end of the financial year, remember, or the end of the tax year, you're going to pay tax. So you've got revenue of 150, cost of goods sold of 100, so you've got a $50 profit, 50 times by 30% tax gives you $15. We need to remove that component as well. Okay. So in the books, so if we did a little worksheet, so we've got the parent and the subsidiary showing the transactions. So remember, the parent has bought the inventory for 150, so their cash goes down 150, their inventory goes up by 150, so that's the parent's account. So treat them separate, put your hand over the parent column, go to the subsidiary. In the books of the subsidiary, they bought the inventory for $100, so there's a plus 100 in there, right? When they sold it, they received cash, right, of 150. They had sales of 150. Then you've got cost of goods sold. You need to recognise the increase in your cost of goods sold and the reduction of your inventory. So upon consolidation, when you're adding the parent to the subsidiary, you've currently got $150 in sales, $100 in cost of goods sold, and $150 sitting in your inventory account. Right, but that's incorrect because you've had no sale and the original price of the inventory is $100. So that's why we do our journal. Debit our sales, 150, credit cost of goods sold, 100, to zero them out from the group's point of view. We also need to credit the inventory because it's currently sitting in the books of the parent at 150. So they only paid 100 with an external party. We need to bring it back to 100. All right. So that's our main journal. The second one is the tax effect. All right, we have to make sure that we adjust the tax effect. So it's not clear on here, but if you added in a couple of lines after the subsidiary, you would have a deferred tax asset and an income tax expense sitting in the subsidiary for $15 each. And adding up the parent and the subsidiary, there's an extra $15 sitting in there. We need to minus that out. Okay. Okay. So, where are we? Here you can see that if we divide it out into our P&L, you can see we've got that current tax liability and the income tax expense in there that we have to adjust. Okay, let's do the next one. So what if the purchaser, the parent, subsequently sells some of that inventory to an external party before the end of the year? So the subsidiary All right, they originally paid $100 for it. They sold it to the parent for $150. Let's say they only sell 40% of it, right? It means there's 60% left, right? So what's the original value? It was $100, right? We've sold 40% of it, so it's $400. It means that our inventory account should only have $60 in there, right? And we should recognise the 40% sale, right? So the external party of $100, so our bank's going to go up. We're going to have a bank account, it should increase by 100. Our sale should increase, right, by 100. We should have a cost of goods sold, so 40% of the original $100 is $40, so your cost of goods sold should be 40, and we should have $60 left in our inventory. All right, so we go back to our original transaction. So I've added it in here, that tax component in the subsidiary, right? So we're going to sell 40% of it. So when we sell 40% of it for $100, notice how in the books of the parent, your cash has gone up 100, your sales has gone up 100. So I'm just putting it there as a minus figure because it's a credit. So treat the minus figure as a credit. All right, cost of goods sold has gone up by 60. Our inventory has come down by 60. So in the books of the parent, their inventory is showing at 110, but it's not 110, is it? Right, because the original value of the inventory was only $100 from the books of subsidiary. But let's go to our parent plus our subsidiary. So currently we've got $100 cash, that's correct. Right, we've got sales figures of 250, but that's not correct because the 150 is not a sale. It's not a sale to an external party. Right, the only real sale is the 40% to the external party. Cost of goods sold sitting in there at 160, but it's overstated by the internal sale. Our inventory account is sitting in there at 90, right? But we should only have $60 in there, all right? So because we've sold 40% of that 100. Now, if you have a look at the books of the parent, because we have a sale and we have a cost of goods sold, by the end of the year when we pay tax, we've got a tax component there. 30% of 100, right, minus your 60 is $40, 30% of that is $12. So we've got $12 sitting in there as part of your current tax liability and an income tax expense. All right, 12, and your subsidiary's got money in there as well, but that shouldn't be there because that was a non-sale. So let's fix it. All right, so the next thing is to remove it, and our adjusting entry will be to remove the original sale of 150. So we're going to have to debit our sale, 150. We're going to have to credit our cost of goods sold because currently when you add the parent and the subsidiary, there's 160 in there, but it should only be 40. All right, because your cost of goods sold is 40% of the 100 that you originally had. All right, so we're going to have to take out 120 there. Now our inventory account's currently saying it's got a value there of $90. All right, but our original value was $100. We've sold 40% of it. 60% of it is $60. So our group account should only have $60 in there. We've currently got 90. To get it down to 60, we're going to have to credit that by 30. All right, what should our tax be? Our tax should be 100 in sale minus $40 in our cost of goods sold. All right, gives us $60, times that by 30%. 60 times 30% is 18. We've currently got 27. All right, to get it down to 18, we're going to have to debit our deferred tax asset by 9 and credit our income tax expense by 9. Okay, so we have to eliminate that original transaction. All right, and that's when we've sold 40% of it. So when they've sold all of it, then it all works out in the end. We just have to eliminate the original transaction. But you can see by doing a little worksheet like this, you can follow it through because you should know what the end result should be. So what was the original cost? What's the percentage you've sold? What should be in the last column? And you can work backwards. All right, quite easily and visually when you're doing a little worksheet like that. Okay, but essentially all you're doing is you're eliminating the original internal sale and then making sure that only the external revenue is showing in the group accounts. Okay, so only external sales should be included in the group. All right, so if inventory is sold between entities within the group 1 year and not sold by the end of the year, we need to consider how this affects the following years of consolidated accounts. All right, so in the following year, when you have multiple years adjustments, potentially you may need to do adjustments to your retained earnings. All right, so as inventory is a current asset, you should be able to reasonably assume that, unless specifically told otherwise, that it's sold to external parties within 12 months of being acquired by the group. However, sometimes we know that that's not the case. All right, so you may not have to do journal entries for inventory, but all of these examples we're showing that we may need to make examples. So if you go back to your original example where all of inventory was still held by the parent as at the 30th of June. So we've got subsidiary, original cost of 100, we're going to sell internally for 150. If the parent sells 100% of the inventory for $175 on the 30th of July 2016, do up a little timeline just to see where it fits in terms of your preparation of your general purpose financial reports and consolidated reports. So 30th of June 2016, 30th of July 2016 is after the 30th of June 2016, so it's in the next financial period. Okay, so original cost was $100, sold for $175. All right, in the books of the group, you can see we've recognised that external group of 175 there in the blue column. Right, that reconciles back to the parent, that cash component. All right, and the sale. The original cost of goods sold, because it originally cost you $100, we need to make sure that we account for that. All right, so but in the books of the parent was showing 150. So in the books of the parent, we had the inventory sitting in there. We've got to minus that inventory out. So your debit and credit is to your debit cost of goods sold, credit your inventory. Right, so we've got cost of goods sold of 150, but it's not 150, is it? It is 100. So we need to adjust for that. So we need to credit our cost of goods sold by 50 to bring it down from 150 to 100. Then, because it relates to a prior year, because remember I did the little timeline down the bottom, we are doing the accounts now as at the 30th of June 2017 because they're not sold until the next year. All right, we need to do an adjustment to our retained earnings. All right, so our retained earnings in the previous year, we had a profit sitting in there of $150 minus 100, it's 50. Minus that your tax gives you $35. So the books of subsidiary last year had recognised a profit. All right, in their books, we need to eliminate that profit. All right, and the income tax expense that's sitting in the books of the parent. So which is your 175 minus your 150 times that by 30% is your $15. So our journal entry, as at the 30th of June 2017, credit cost of goods sold 50. We need to debit our retained earnings by 35 to eliminate the profit in the subsidiary from the previous year. There, and we also need to adjust your income tax expense by $15, right? Because in the books of the group, our tax figure should be $175 sales minus your cost of goods sold of 100 gives you $75, times that by 30%. So 30% of $75 gives you $22.50. Right, our ending income tax expense for the group is $22.50. Currently, we're only showing the income tax expense in the books of the parent, $7.50. We need to increase that by $15, right, to $22.50, because in the books of the subsidiary, that income tax expense had already been rolled over, all right, to your retained earnings. Because remember, profit and loss, revenue, minus expenses, right, minus out the tax, difference goes to your retained earnings. All right, so prior year adjustments need to come out of retained earnings to eliminate the unrealised profit. So let's have a look at property, plant and equipment. Consider this example where 15, just looking at the amount of time we might get through it yet. So consider we've got a subsidiary, they purchased machinery for $100 on the 1st of July, they depreciate the asset at 10% per year. On the 30th of June it is sold to the parent for $150, the tax rate is 30%. Any unrealised profit or loss on the non-current asset transfer will be realised by the group, not by the sale but by its use, hence the realisation. We're going to have to make sure that we adjust the pattern of depreciation. So there's a two-step process. So we need to remove any intra-group profit or loss, and number two, we need to do any additional depreciation adjustments. All right, so using the worksheet for the consolidation, so we've got a scenario where the parent has paid $150 for the subsidiary, had purchased a machine. The original price was $100. They've sold it to the parent for $150. All right, so we need to make sure that we adjust that proceeds on sale in the books of the subsidiary, $150. Right, it's currently, remember, proceeds on sale, a revenue item, revenue was a credit. To remove it, we need to debit. So we're going to debit that revenue account, proceeds on sale of $150. The carrying amount of the machine sold, we're going to have to adjust for that, for the depreciation there of $90. The original cost of the machine, we need to, it's currently in the parent plus the subsidiary at $150. We need that to go back down to your $90, which is your original cost, written down value, which is $100 minus 10 depreciation. All right, so we want to eliminate that, make sure that there's no accumulated depreciation. All right, so in the books, we need to adjust for that. So in following years, we need to account for that as well. So let's have a look at it here, account for that depreciation. So we've also got to account for the tax effect of $18. That tax effect is your $150 minus the $90, gives you $60 times that by 30%. All right, that's the tax effect of the depreciation. Right, so let's have a quick look at this. So in the books of subsidiary, the written down value at date of transfer was $90. The remaining useful life was 9 years. The depreciation per annum is $10 per year in the books of subsidiary. In the books of the parent, they purchased it for $150. There was 9 years remaining. So 150 divided by 9 is $16.67 per annum. All right, so what we need to do is we need to make sure that we account for that difference. So the difference in the written down value and the difference in the depreciation. So that written down value there of $60 over 9 years is $6.67. So we need to make sure that we account for that depreciation, right, in future years of $6.67. Right, and we need to account for that accordingly. So in the financial year 2016, our journal entry that we've already done before, we're going to debit the proceeds on sale $150, the carrying amount of the machine sold $90, the machine at cost $60, our deferred taxed asset and income tax expense $18, which is 30% of that $60. So in the next year, right, the next year we've got a new journal entry because we have to account for it against our retained earnings. All right, we need to account for that deferred taxed asset and an adjustment against our retained earnings for our proceeds on sale. All right, so our retained earnings, we're going to have the tax affected amount of $150, what we paid, minus the $90, all right, which is $60 times by 70% is 42. Deferred taxed asset of $18, which is the repeat from last year, which is 30% on the $60, and the machine it costs $60. So we are basically adjusting against our retained earnings into the future. All right. And the next one is your accumulated depreciation, because in the previous little schedule there, we showed that the difference between the subsidiary and the parent, so what it originally cost were the $10, the difference there is $6.67, so we need to account for that $6.70. I just rounded it to $6.70. All right, so reduce the overall depreciation expense recognised because it's currently overstated. It's overstated in the books of the parent because there was no real sale of that machinery. We've got to make sure that our group accounts reflect the original value. The tax effect on that $6.70, 30% of that is $2. So we need to account for the tax effect as well. Debit income tax expense, credit our deferred tax asset. Right, so in the next year, our depreciation gets adjusted again. All right, by another $6.70, and our income tax expense goes up to $4. All right, so for the financial year 2018, it's a repeat. So you can see our depreciation changes. Again, we have got depreciation of $6.70. We have to adjust the last year's depreciation adjustment goes to retained earnings, $6.70, and our accumulated depreciation is now $13.40. So that is to reduce 2 years accumulated depreciation. Right, so each year as you go on, you're going to add another year, add another year, add another year. We put in the current year against the expense, prior years goes against retained earnings. All right, so if you were 3 years into it, 1 year in the expense, 2 years in retained earnings. It would be 4 years into it, again, 1 year, $6.70, 3 years into retained earnings. All right, and then we need to do our income tax effect. Again, we also affect retained earnings. So the current year's income tax of $2, prior years goes to your retained earnings. All right, so we're going to progressively write back that deferred tax asset that we've got, an original amount of $18. We're going to write that back over the next 10 years. Okay, so that'll come back to zero. Other transfers, so services revenue and expense, so you need to remember in the books of the subsidiary, if they have got an expense for services revenue, it will be in there as a debit. To get it out, we need to credit it. All right, so we need to credit any service expense. We need to debit the service revenue to take it out of the parent. All right, or if it goes the other way, if the subsidiary is providing a service to the parent, depending on where the debit and credit sits, we either have to debit it out of the amount of the service revenue from the subsidiary or the parent. Journal entry will be the same because you're always going to be reducing the revenue. You have to reduce the revenue and reduce the expense. Dividends, all right, so there's dividends paid, dividend receivable, right, there's also your dividends payable in that as well, all right, so remember if there are dividends, so if you're paying dividends and cash is going down, obviously the cash will net each other out. Whenever you're doing intra-group transactions, you never do an adjustment to cash, all right, you never need to do an adjustment to your cash. You might have to do an adjustment to revenue, expense or asset and liability accounts. All right, so on your journal entry, upon consolidation, you need to adjust for the revenue and for the dividend paid. There's also where you've got a declared and a payable and a receivable as well. So sometimes you've paid it, sometimes you haven't. Sometimes it's a payable and a receivable. You need to make sure that you adjust accordingly depending on how it's directed as to whether it's being paid or whether it's a payable or receivable. All right, your main journal entries on consolidation is to debit your payable, because remember, payable is a liability. It'll be in the books as a credit. To get it out, we have to debit. All right, you've got a dividend declared, currently in there as a debit. against your retained earnings. To get it out of there, we're going to have to credit. Dividend revenue, so revenue is always a credit. To get it out, we're going to have to debit. Your receivable is an asset. Assets are a debit. To get it out, we have to credit. All right, so we just have to zero that out between them. So we have an organisation that's not wholly owned. We're at 60%. Obviously, you'll appreciate your journals will be 60% of that. All right, but for the purposes of you need to focus on 100% because everything that